Good morning. Hi, Mark.
Hey, how are you? Thanks for
Good.
having me.
Absolutely. So, welcome to the very first episode of the In Quest of Better podcast, where we are here to collaborate and have discussions on how to help agents have a better life and a better business. So, you are our first guest. So, welcome.
Heavy pressure.
Yes. So, we have Mark Yecies from SunQuest Funding. Mark and I have been collaborating for many years. He was my lender, and he's helped many of our clients. He and his partner, Chris Weigland, founded SunQuest Funding, which they have an office in Cranford, but cover all of New Jersey. And so, Mark, I guess, why don't you kind of start off by giving us a little bit of an overview of what's going on in the market. There's been a lot of volatility and a lot of news about, are we in a bubble? Is this busting? So bring us up to speed on the facts and the stats.
Okay. Well, I believe that we're going to see a correction, but not like a 2009 correction. We might see a softening of prices, like more like a 2000, 2001. We might see a 10%, 15% reduction or in price. We're definitely going to see a slowing in prices going up, in appreciation. It's completely different this time for a couple of reasons. A lot of the factors that I have to start over because the words aren't coming this morning. I'm tired. I apologize.
Okay, I know, I am too.
So the factors around the market are different. First of all, buyers who have bought through this market are highly qualified. They have money, they have jobs, they have big jobs in our market, which is higher priced. Many of them have big jobs and, frankly, their employers are running their credit every year. Like they can't have a foreclosure. They have lots of money in these houses. I mean, even if you buy an $800,000 house and you put 10% down, that's still $80,000. It's a lot of money. People are not going to walk from that money. They're not going to walk from their houses. In the last market, you had somebody with a 580 credit score getting 100% financing, and we're not looking at their pay stubs. We didn't do those loans, by the way. And if you have a 580 credit score, it basically means you never paid anything on time ever, and you have no skin in the game. So what makes anybody think that you'd make the mortgage payment? They're really renters with no responsibility. So
it was a hard lesson learned.
Right. Yeah. And so we're in a different place in terms of the quality of home buyers. I'm not saying that there's going to maybe be some job losses and some foreclosures, but it's not going to be on the scale that we had in the past. The Fed is doing their best to slow the housing market right now, slow the home price appreciation through a combination of raising rates and tightening lending guidelines. The FHA, we already know, but Fannie Mae and Freddie Mac are owned by the federal government right now. So they have been tightening some of their approval processes. Not overtly, they haven't changed underwriting guidelines, but every loan has to go through Fannie or Freddie's computerized underwriting system. And if that loan does not get approved through the underwriting system, then you're not getting a mortgage because the loan won't be purchased by Fannie or Freddie. So, and that has tightened things that flew through in the past. We've been getting some pushback on, and so.
Can I ask you a question?
Yes.
Why do you think? We talked about this the other day about how the Fed is still kind of having a hand in this because the increase to the 5% interest rates didn't really have the effect of slowing down the market as much as they thought it would. So,
right.
What more are they going to do in your mind?
Well, we're probably going to have a couple more rate increases. Okay. And I think that's what they're going to bank on. Usually the housing market slows down when we enter a situation like this. And that helps lead the slowdown in inflation, because right now home prices are a big factor in inflation. I mean, they are a consumer purchased good, and prices are going up, it contributes to inflation. Part of the frustration that the Fed is having is that not all of our inflation is under our control. You've got Ukraine, which is the breadbasket of Europe, which cannot produce grain right now because of that war. China is in continuous lockdown over COVID, and they still manufacture a great deal of the not just the raw materials and products that consumers buy. So if manufacturers can't get raw materials, consumers can't get product, that also affects prices because there's demand and low supply, and the Fed cannot corral that inflation. It's caused by world events, and as much as some people would like us to have a more nationalistic view, we live in a world economy. The world is smaller, and those factors will affect our rates and our prices. And anytime there's inflation, the Fed's going to raise rates. It is what it is.
Any other factors?
That's not enough. I mean,
well, so when you have a buyer right now, saying, Mark, we've been looking, do you think that now that, the press is saying that we've reached the peak, prices are only going to go down from here or start stabilizing, and you're consulting with them and they're like, should we wait a little longer? Like, what is your advice there? Like, do buyers think that they should wait until prices go down a bit further, or is the impact of the rates going up meaning that really now is the perfect time to buy?
Well, it may sound crazy, but it's never really a bad time to buy real estate. It just depends on what your timeline is. Okay. So if you're looking at a 3 or 4 year timeline, it might not be the perfect time to buy. Okay. But if you're looking for a house to live in and raise your family and put down roots in a community, it just doesn't matter. And I'll use myself as an example. I bought a house in 2006. I didn't have a choice. I needed an extra bedroom. We had a baby that was 10 months old and sleeping in our bedroom, and it just wasn't working. So we bought this house, and at one point we owed $100,000 more than the house was worth because of how prices came down in 2009. But now it's, we've been there for 15 years and the house is worth well more than we paid for it and well more than we owe on it. And so real estate will always probably appreciate. It's just a matter of, the ups and downs, the ebbs and flows of the market. So if you're looking to, as I say, put down roots in a community, go ahead. But if it's temporary, you might think twice.
Yeah, that makes sense. I mean, it's really, somebody had posted something recently about, when you look at the stock market, and if you're looking at it, in a super granular level, and you're seeing all these ups and downs, but if you zoom out, you'll see that it has an upward trajectory. And I think that, the housing market has shown that it's the same thing. So, so good. That's good to know. And I know that, you've been working with a lot of our buyers. A lot of people are looking to get pre-approved, thinking that now is the time to hop into the market. So, I also wanted to thank you because you, like I said at the beginning, have always been a supporter of our team. And I wanted to tell you how grateful we are that you and Chris have decided to be a platinum sponsor of this conference that we're hosting, which is a conference really for agents in the tri-state area. We have, it'll be on October 1st at the Short Hills Hilton. I know that you have saved the date, and we're looking forward to having you be there and mingling with the agents and meeting our keynote speakers who are flying in from all over the country. And we're really, it's kind of this conference is going to be a first of its kind in New Jersey, at least in the past 15 years of me being here and doing business in this industry, in that it's a brand agnostic conference. All brokerages are welcome. We're going to have representatives from all brokerages speaking about their experiences, their forecasts. And, it's going to be kind of an intersection of real estate, technology, marketing, branding, and how to build your business and how to scale. And it's really, we're really going to bring a lot of value, and we're super excited, and we really couldn't have done it without you. So thank you for your support. I thought that this would be a good opportunity for you to, you've been in the business for so many years, and I know you know a lot of realtors, and you have a lot of loyal realtors who work with you because, number one, you give no BS, you straight talk us, you straight talk our clients, and you provide amazing service. So why don't you kind of talk to me a bit about your philosophy on that, and kind of the services that you provide to agents, and why you think you make a difference for us?
Sure. Wow, that's a tough one, but it's not a tough one. I mean, in my mind, and clearly different people have different needs, different clientele. We
Right.
have two clients. We have our borrowers and we have our referral sources, and you have to treat both of them very well. I think the biggest thing that the real estate agents that I work with is if they have one of my pre-approvals, unless something drastic changes, the loan is going to close. It may be bumpy sometimes as things change. Really, the only reason we've ever had something not close is we've had borrowers lose their job the day before the closing because, we do a verbal verification of employment within 48 hours of the closing. But that would be the only reason. As you say, we give a lot of advice. We are available to help real estate agents answer questions. They have an offer on a listing and they don't understand something that's coming from the mortgage company on the other side. We get involved. We do all those things. We even help with a borrower that may not be ours on one of their purchases, just so they understand what they're facing. So just being available and offering services that don't affect our bottom line, I think, is what a lot of our real estate agents appreciate. We're not pay for play. We're not inside of a real estate office paying to get referrals. Our referrals come from us doing the right thing by people, and there's no conflicts. There's no conflict of interest. I don't have to worry about the office manager in office is going to kick me out of the office and stop our sponsorship because we didn't put a transaction together that they wanted put together.
Right.
And those things I think are better. There's no gray area.
Yeah, absolutely. Yeah, I mean, there's countless examples. I know that you were recently on our other podcast, and we talked about, how you really saved a buyer from making a mistake. She was working with, I think, Rocket Mortgage at the time, and they don't scratch the surface. I think that that's part of the difference that the value that you bring is that you take the time to scratch the surface and get a little deeper, because you always uncover something that is very relevant to the transaction. Whether it's an easy fix to their credit or a red flag that they should address before they get pre-approved. And the big banks just don't do that. It's like a mill. It's like a mill, and then the red flags rear their ugly head right before closing, and then everything gets hijacked. So
it's about low-hanging fruit for them. They have so much volume that if something's not directly in their wheelhouse, they're just not dealing with it effectively, really.
So. And I know that a lot of the agents, from all different brokerages that I meet that work with you as well. I think we all share the same opinion of you, is that, you're solid, you're professional, and you're right. Like, if you give out a pre-approval, it is solid, and we can trust that, you've dotted your I's and crossed your T's, and then, we can put in the work and let the client know that they're in good hand. So.
Right. And then, also we'll work with somebody for 6 months or a year to get them ready if they're not ready. And one of the things that there's something called a rapid rescore, which basically means that a borrower can manipulate their credit in certain ways to help their scores come up. So if they're not bankable before, they become bankable by us helping them do that. And we go directly to the repositories, report the new information, and the credit scores get changed, right away within 24 to 78 hours, instead of waiting 6 weeks for the creditor to report again. And the big banks won't do that. They just won't.
Right.
Whatever your score is, and they're working off of that. And that's another thing that differentiates us, I think. And we also will help with some strategies in this, multi-bid environment to help make a borrower, more attractive to a seller. Like, for instance, a borrower wants to put 10% down, but they have enough cash to put 20% down. We'll put the offer in at 20% down. And then if the mortgage approval comes through with 10% down, it doesn't matter.
Right.
Because the seller's getting their money at the closing table. They don't care if it comes from us or it comes from somebody else.
Right.
Things like that.
Yeah.
So.
Yeah. It's customizing the approach and staying on top of the details.
Right.
And I think also, you and I share a big network of service providers that we, have created those relationships over the years with people from the Executive Association of New Jersey, from the various chambers, the local chambers. And we really care about who we bring into the fold on the transactions that we work on together and make sure that our clients are in good hands. And I value that too. I think that, knowing that you and I see eye to eye on that is a real comfort in the transaction. So,
right.
Well, listen, Mark, I think that, the market is definitely in a shift, but I don't think that things are going to look too different for you and I over the next year. I think we're just going to continue to do what we do, which is service the client and do right by them. And, that will just breed more referrals. And there might be some ups and downs here and there, but I think generally speaking, it's data over drama. I think there's so much drama going on in the news about the market. And I just think you just have to kind of stick to the data and just realize that, there aren't any drastic things going on. And that even rates going from 3 to 5%, while it is a considerable and kind of, record raise in the rates, it's still not affecting, affordability all that much. I mean, it's still a very reasonable rate compared to, say 15, 20 years ago. So
yes. And I will say, like a $400,000 loan, you're looking at a $300 a month difference in the payment. If that is going to keep you from affording a house, then you shouldn't have been buying that house in the first place.
Right. And there you go, telling it like it is.
Yes. Yes.
Well, listen, Mark, thank you so much for being our first guest on In Quest of Better.
Thank you.
And have a wonderful Memorial Day weekend. And we look
too.
forward to seeing you at the In Quest of Better conference on October 1st.
Likewise. Take care.
All right. Take care.